The returns to investors from UK government bonds, or gilts, of the various terms to maturity collectively form a crucial component of the personal finance landscape, the risk-free yield curve. A yield curve is the line graph that joins the returns that investors get from bonds with different terms to maturity. 1 year, 2 years, 5 years, 10 years, 20 years, etc. A yield curve therefore represents what is known as the term structure of interest rates. The yield curve from gilts is called risk-free as they are assumed to be completely free of a risk of default by the issuer, the UK government. The slope of the yield curve reflects market expectations about the future movement of short-term interest rates, like the Bank of England's bank rate or official rate of interest. If the slope is sharply upwards, short-term rates are expected to rise in the future. If the slope is sharply downwards, the expectation is that short-term rates will fall in the future. Note, though, that these expectations may not be matched by what actually does happen in the future. We can also see how the risk-free yield curve in the UK compares with that for the US. The latter is provided by the yields on US government bonds called treasuries.